recording. Okay. And Cassidy, when you signed on and your mic was open and there were baby noises, well, it was the best part of my day so far.
I know. I didn't notice it at first. I was like, oh, she's talking to you all.
It really was. Like, I just don't get enough baby noises in my life. My grandbabies live too far away.
Aw.
Um, anyway, so I love babies. Anyway, so a couple of general things. First of all, um, I went through and I did what I would call a very cursory read through of everybody's paper, the rough drafts of the papers people turned in. And honestly, again, I said this in the beginning, but I want to reiterate it. This is not something, if I were you, that I would put tons and tons of time into. In other words, I would, if you write a decent paper that follows that outline, which is like, why did you choose it? I think it's why did you choose it? A summary of the paper and what did you learn from it? You're going to get full points. Okay, like that's it. I'm not an English teacher. Not, and I don't think it's not valuable. I think it's valuable to have to find those sorts of sources because you'll use them more and more. And if any of you go on to graduate studies, for sure, that's a master's degree is just research if you think about it. I mean, it's other stuff, but it's research and then analysis of that research and synthesization. I'm pretty sure that's how you say it. Anyway, so I don't think it's not valuable. I just, it's not the primary function of the class. So don't worry too much. So I just wanted to throw that out there. Anyway, so, and then I don't really have any other general type of announcements. Any general, in other words, what I mean by general is non-content, non-accounting specific accounting problem type questions that you wanted to ask before I launch into talking about accrual concepts. Yeah, Beth.
So I've read lots of horror stories about Proctorio on the Facebook group, and I haven't done my exam yet, but I've been thinking about if we do encounter an issue where it kicks us out, do we need to contact you, or is it just we work with Proctorio themselves?
Yeah, so there's nothing I can do. That's
Okay.
that's what's one of the hard things about being a teacher in these online classes is people go like, I can't get into Wiley Plus, and you're like, I don't have any administrator privileges in Wiley Plus, and so I feel like I'm blowing them off, like I'm just telling them like you have to talk to Wiley Plus support or Proctorio, and it's like, you'll have to talk to Proctorio support because I have no back end and privilege, like I can't log in and see what's happening there. So
Yeah.
anyway, for all the horror stories, like if I have 100 students between two sections, honestly, 4 or 5 people have a problem with Proctorio. So in other words, like 90% of the time plus, it's fine. Like it just works the way it's supposed to. Or maybe someone gets this thing where I'll prompt them for a password, and then they'll text me and say, it's asking me for a password. And I'll say, that just means Proctorio's being stupid. And so just restart Chrome. And if that doesn't work, then delete the plugin and reinstall it. And that like fixes it. And other than that, I mean, I'm sure everybody has their Proctorio horror stories. Oh, and so yeah, this to sort of piggyback on that question, people were kind of nervous about it before the exam, and I said, the way Proctorio works is it watches and makes sure you're looking at the screen and make sure you're doing your work. And if you don't, if you look away too long, or if it looks like you're looking at notes, it flags it. And then the flag gets sent to a human reviewer who reviews it. And if they, after looking at it, still feel like it looks like you were cheating, then they send what's called an exception report to the instructor that says, hey, look at this timestamp time. It looks like the student is looking at notes, or it looks like the student, whatever. And so from this first exam, I got clean reports back. In other words, so if you felt like, man, I looked away and I don't know if it was judging me, or I had my kid ran through the room, or just know that whatever you did on that first exam, it did not create a report against you, because everybody who took it, it was fine. So anyway, I think the idea of like some AI watching you like just takes you back to the worst part of any sci-fi movie, and everybody's just like, I don't like this. I'd rather my mean ninth grade chemistry teacher be staring at me than this. Maybe you never had a mean ninth grade chemistry teacher. Um, I don't know. No? Okay. I was when I was learning Chinese at the Defense Language Institute was my meanest teacher. This guy would hit you with a stick. Uh, he would just say some phrase in Chinese, and then or he'd say some phrase, and then you were supposed to like give him an English translation, and then he'd just like look at you, and he'd be like 53%, and then whack you with a stick. But got better at Chinese, I guess. I guess it worked. Anyway, okay. So any other general questions? I promise not to go on like a lengthy monologue. If you dare to ask a question this time, I'll just be succinct.
On the percentage for the paper, the percentage, I can't remember what it's called.
The originality report?
Yeah, thank you. Originality report. I did my first one and it was within the amount very comfortably. With that, is that all we need to worry about that, or do we have to worry about that going forward?
So, like you're talking about like the where it looks at other papers and other sources and makes sure you're not plagiarizing. Is that what you mean?
Yeah, the originality. I just want to make sure that with what we showed up with that, we're not gonna with that. We shouldn't have any issues with that going forward.
Yeah, so the originality report is just another one of those tools that as a teacher you have to make sure people aren't cheating. And so if somebody gets a high originality report score, all the, on a rough draft, all I'm going to do is like, hey, you're getting a high score. That doesn't necessarily mean you're cheating. Just make sure you're properly citing the sources you're using. If it's a direct quote, put it in quotations. If it's a paraphrase. So what I would say is, if you're not plagiarizing, if you're not taking chunks written from somebody else's work, and then you don't really have anything to worry about. Even if that number was high, but you're citing it properly, you're okay. Now, of course, if somebody just in essence takes somebody else's paper or takes 3 other papers and takes big chunks out of those and puts them in there, then you'll probably get a 0 on it, right? Because that's cheating. But so I would say if you had a low originality report on your rough draft,
we had like 3%.
then you probably have nothing to worry about. If you add big, if you say you make a revision to it where you add a big quote from something else, just make sure you properly cite it. You'll be fine.
Okay. I overthink anything dealing with that kind of stuff because I always want to be in the errors, have enough coverage in case I don't want to ever have a question about it. So that's the reason I overthink it sometimes.
Sure. Yeah.
Brother Fox, I have one more thing.
Okay.
And by the way, is that how you want us to address you? Is Brother Fox?
I wish you could address me as Mike, but BYU really wants us to do the whole brother sister thing. Or the reason I don't like it, I guess if I was supposed to call you Sister Bolton, I'd be more okay with it. But they want like instructors to refer to students by their first. It like creates this whole like I'm mature and serious and I'm your seminary teacher dynamic or something that I'm totally not that comfortable with. So
I've worked in a school before. They changed policies on us with that too. I used to be Miss Beth and then I couldn't be Miss Beth anymore. Yeah.
Well, at EAC, people just call me Mike. Even my students, I don't care. So whatever. So yeah.
My question pertains to how the extra credit affects our grade, because I've tried playing around with it in in Canvas and it doesn't affect it any way, shape, or form.
Yeah. So because Canvas is dumb, that's the technical term for it. If I give the extra credit category a weight right now, like if I weighted at 1%, and I'm not sure anyway. If I do that, then the people who don't do the extra credit, it looks like they're losing points. And so instead, what I do is I leave it at 0 weight, and then I add the points at the end. So I know that, so from your perspective, it doesn't look like it's doing anything because it's not right now. I will tell you this, and I think I've mentioned it in other meetings, but we are just by rule not allowed to give very much extra credit. So like, if a person participates 100%, meaning they, comment on each one of those discussions, I think there's 6 of them throughout the semester, then that's going to increase their final grade by like 1%. Okay, so it's 1%. Now that's a lot if you're sitting on the bubble and it's going to push you from a D plus to a C minus. Then that 1% is a whole lot. So I tried to make it something that maybe was valuable to participate in, even if you got no credit for it. But and so so if a person does half of them, then they end up getting a half of 1% grade. I mean, but it will be added in at the end is the short answer. That was kind of a lengthy monologue. It was slightly less lengthy than the last.
Thank you for the answer. That's actually something I did have a question about that I've never been able to figure out on the grade on the grade book.
Yeah. All right, are we ready to look at accrual versus cash basis accounting? It's gonna be exciting.
I got
Or
a
as
quick
my kids say, it's gonna be dope.
I was just saying.
All right. Yes.
Hi, yeah. Sorry, y'all are on my phone, and I have the interpreter super big on my laptop. So I did the work, and I think I might have messed up, maybe my internet or something. The entire thing shut down. So, and it gave me an automatic grade of a 0, and I'm kind of confused. I don't want to lose points, of course. So I'm not sure what I should do with the, I believe it was conveyance system. Since it was a crash, I couldn't email you because it had obviously crashed, like I said. So how should I change that whole thing to where I don't lose points on that?
I'll have to go in and look at it, and if I can, I mentioned just a minute ago that I don't have admin control, but I do have the ability to like reset an assignment. So I'll have to go in and see if I can reset that. But I have no way of seeing how much you did or didn't do, probably. Were you partially finished?
I was just bouncing back and forth, so I'm honestly not sure how far the way through I was.
Okay.
Just figured out I was going.
All right. As soon as we get off the meeting, I'll go in, take a look, and I'll email you.
Great. Thank you.
All right. Okay. Let's take a look. Let me. All right, I'm going to share my screen with you here. Okay. So some of you maybe already are feeling comfortable with the difference between accrual versus cash basis. Others, it may seem so abstract that it feels like you'll never understand it. I mentioned at the beginning of this that this was a hard section when I was taking this class 20, a long time ago, and it's still confusing. So I will do my best to try to demystify it a little, because it's not rocket science, but it is a little confusing. So the only difference between accrual basis and cash basis is what events would lead us to recognize revenue and expense. Okay, so under the accrual basis of accounting, what we're doing is we are recognizing our revenues when we earn them. So if we're a business, when we provide service or when we provide a good to a customer, we're going to recognize revenues then at the point when we deliver this good or service. So even if the customer paid us in advance, or if they're not going to pay us till later, it doesn't matter. We're recording revenue when we deliver the good or service. Expenses, we are recording when we incur them. So that means when we actually use the good or service of another person, okay? So even if we had paid for those goods or services in the past, or we're not going to pay for them to the future, it doesn't matter. We record them as an expense when we incur them, meaning when we use the good or service of someone else. So that's under the accrual basis. In the cash basis, we're recognizing revenues when we receive cash, even if we haven't performed the service yet, okay? And we're recognizing expenses when we pay cash, even if, again, if if it doesn't match up with the incurring of that expense. So cash basis is easy in the sense that it sounds like its name. Okay, we earn revenues, or we record revenues when we receive cash, and we record expenses when we pay cash. Cash-based accounting is not usually considered acceptable for GAAP, which is generally accepted accounting principles, which is the rules of accounting we use in the United States. That being said, very small micro type businesses are actually allowed to use a cash basis when they file like a Schedule C, which is a self-employment return. They can just mark cash basis. If you think about it, for example, my wife has a business. She's a painter. She paints murals, and it's what she does is people pay her half up front. She paints the mural. They pay her half at the end. During the process, she's buying supplies. Sometimes she's hiring people to do base painting and things like that. And so, and she maybe does $10,000 a year worth of business. She's not interested in taking every job. She picks the ones that, I don't know, appeal to her artistry, however artists work. I don't know. I like, if it's on a spreadsheet, it makes me happy, but I don't have deep artistry. So for her, it just makes sense for her to kind of record when she gets paid. And she's such a small business, it's fine. But typically, our other business is a storage business. And there we do have people who will pay us for a whole year's worth of storage. But we can't record that as revenue, the whole payment, when they give it to us, because then it will look like I had this big amount of revenue in January and then no revenue for the rest of the year. And that's not really true. What they're doing is they're paying me for the monthly rent just a year in advance. So I'm going to instead I'll record it as an asset called unearned revenue. I'm sorry, as a liability called unearned revenue, and an asset cash because my cash went up. And then each month, when they actually stay in the storage for another month, I'll reduce that liability and record it as revenue because I'm earning that revenue month by month throughout the year. So for our other business, we use an accrual basis. And if that's even better for my brain. Right now I have to do one of each. Maybe that's a bad idea. Maybe I should switch hers to accrual based too. So within the accrual system, there's 4 types of adjusting entries. And what we mean by adjusting entries is because the cash payment and the incurring of the expense or the earning of the revenue don't match up, we have to make an adjustment. We typically do this at the end of each month, end of each period, usually a monthly period, to make that all work, okay? To recognize the activities that occurred during the month, okay? So the 2 types of so there's 2 broad categories of adjusting entries: deferrals, and most of us have heard the term deferral or defer, which means to put something off until the future, okay? And then there's accruals, and accruing something means to add up over time, okay? So those are the 2 categories. And then we have the types of deferrals are prepaid expenses. And so if you think about it, a prepaid expense is where we pay for some expense now using cash, but it won't become an expense until the future when we actually incur the expense, either by using up or consuming an asset, that's pretty much what we're doing. We're using up or consuming an asset. And I'll go through some examples of this in a minute. So a prepaid expense is a deferred expense, meaning today we record it as an asset, and then as we use it up, that asset up, we recognize it as an expense in the future. We're deferring that expense until a future period. And then the deferred revenues are unearned revenues. So that's the one I just sort of described, where a customer pays me cash in advance, but I haven't earned the revenue yet. So I'm going to record that as a liability when the customer pays me because I owe the customer the service. And then through time, as I earn that money, I'll reduce the liability and record the revenue. So again, that's a deferral. I'm pushing the revenue off until some future point when I actually earn it. So those are the deferrals. And again, I'll show you some examples. And then accruals, again, to accrue something means to add it up over time. So an accrued revenue is revenue for service performed but not yet received in cash or recorded. So for some businesses, lawyers and accountants, for example, it's pretty normal to just sort of work for the customer throughout the month, and then at the end of the month, add up all the hours and record them and say, and at that point, you bill the customer for revenue you've already earned by working for them through the month, but have not yet received any cash for. So what we're doing is we're recording the revenue now and creating an asset, accounts receivable, where the customer will pay us in the future. That's an accrued revenue. And then an accrued expense is an expense that we've incurred but not yet paid for. So it could be any sort of scenario where, say, for example, our employees are working each day, right? Each day an employee works, I owe them the money for that day, but I don't really have to record that. I just keep track of their hours. But when I hit the end of the month, I've got to know what my expenses are so I can create my income statement. And so I have to add up all the money I owe them, even if payday is not until, the first of the month. On the 30th, I still have to recognize all the expense I've incurred, and then I'll pay them cash on payday. Okay. This is especially true. My employer pays on the 15th and 30th, so they don't really have to worry about accruing expenses. They just record the amount we've earned on the 15th and 30th. But a lot of employers pay every Friday or every other Friday. And so then they're going to have expenses that they've incurred, people working, but that they won't actually pay out until the next payday. All right. So that was a complicated, big mess of talking. So let me show you a couple of examples. So here's an example of a prepaid expense. Expense paid in before we consume the asset. Okay, and here's what I mean by that. So typically, these are the types of accounts that we prepay: insurance, rent, supplies, and then the things like supplies, equipment, buildings, those are a little different in their nature than insurance, rent, and advertising. So when we prepay for insurance, what we're saying is, hey, I'm going to give you this money, which is going to give me insurance coverage for the whole year. Okay, and then we recognize each month that a portion of that prepayment is being used up as insurance coverage, and we're going to claim it as an expense. But other things like assets, supplies, we actually take physical ownership of, and we record them as an asset called supplies, and then we record the expense of them as we use them up. And so usually what you do is at the end of the month, you go count up, you said, I know I had $1,000 worth of supplies here, and you count them up and say, now we only have $700 worth of supplies, so we'll take an expense for the $300 that we used during the month. With things like equipment and buildings, we're going to use something called depreciation. And depreciation sounds like, people always think it means like it's the value our asset is losing, but it's not really that. Instead, it's us allocating the cost of the building as an expense spread out over the asset's life. If I'm going to use a building for 20 years, it wouldn't make sense to claim it all as an expense the day I bought it. Instead, I would take its cost, divide it by 20 years, and then take 1/20th of that cost every year as an expense. So that's what the process of depreciation is really doing. It's spreading the cost out over an asset's useful life. All right. So this is important. Prepaid expenses, adjusting entries always look the same. Okay. It's always an increase to an expense account. So we debit an expense account, and a decrease to an asset account. So we're going to credit an asset account. Always the same. So what's nice about these is there's only 4 real entries, okay, for these adjusting entries. So again, like, how accounting is, the math's pretty easy, the entry's pretty easy. The real trick is figuring out which one applies here, right? That's always the real hard part with accounting is saying, what accounts am I dealing with, and so how does this apply? So here's an example. Sierra Corporation purchases supplies that cost $2,500 on October 5th. Sierra records this purchase by debiting the asset supplies, and they probably would have credited their cash account, right, if they paid cash for those supplies. So the account will show a balance of $2,500 on the October 31st trial balance. We'll usually call that an unadjusted trial balance. Then we do an inventory count at the close of business on October 31st, and it shows that we still have $1,000 worth of supplies on hand. So if we had 2,500 and now at the end of the month we count them up and there's 1,000 there, we must have used up $1,500 worth of supplies. So what we do is we debit the supplies expense, $1,500, and we credit the supplies account. So like I said, you'll debit an expense account and you'll credit an asset account to do the adjusting entry. So that's the process for doing this adjustment. If you have a question, don't be afraid to jump in and ask it, by the way. I know I get going rapid fire sometimes. And
I got a quick question for you.
okay.
Saying, so to clarify, so we would subtract from the 2,500 the $1,000 for the supplies that we have, and then what we have left would be what we would credit the account, correct?
So the $1,000 is what we have left. And so what we're trying to credit, so what we're trying to credit the account here is the amount we used up. So we had 2,500 on the at the beginning of the month. Now we have 1,000. And so the difference is the amount that we used up during the month. And that's the amount we're going to credit to the supplies account and also debit to the expense account.
Gotcha.
Here's another example of a similar type of problem. October 4th, Sierra Corporation pays $600 for a 1-year fire insurance policy. Coverage began October 1st. Sierra records the payment by debiting the prepaid insurance account. The account shows a balance of $600 on the October 31st trial balance. So it wants us to figure out what's the adjusting entry for this. So for these type of deferred expenses, all we're going to do is say, okay, the cost was 600. This is for 12 months. So I'll take 600 divided by 12. And then at the end of each month, I will debit an insurance expense of $50 and I'll credit my prepaid insurance account. So again, to figure it out, you just have to know the life of it and the cost. Okay, so it's the cost divided by the how long it's going to last. So if it's $600 for a year, that's the same as paying $50 a month. And again, if you think about it, recording this as a $50 monthly expense actually makes more sense than recording it as a $600 one-time expense, because you're getting monthly insurance protection. That lets you spread that insurance expense out, which is more accurate for your income statement. All right, so one more here, I think one more on deferred expenses. So depreciation, I mentioned this before. Anything that we call a long-lived asset, that's usually buildings, equipment, motor vehicles, not land, by the way. We don't depreciate land. We don't expense land. That's an IRS rule. But other long-lived assets, meaning assets that will last usually longer than a year or so. Most places that's around, if it lasts longer than about 5 years. What we have to do is spread out or allocate the cost of the asset over its useful life. And this is called depreciation. So here's what I was trying to say earlier. Depreciation does not attempt to report the actual change in value of the asset. In other words, if it was a building, it might go up in value. We're not worried about its actual resale value. We're worried about its cost, and we're spreading its cost out over its useful life. So here's an example. Sierra Corporation. I don't like this. It didn't give us additional information. So a lot of times what it will do is it will just tell you, here's what you paid for the asset, and this is how long its useful life is. And then you have to calculate how much it is per year by taking the amount you paid for it, the cost, divided by the number of years in its useful life, and then divide that number by 12 to get its monthly depreciation. This example didn't have that. So once we've calculated our depreciation expense, it'll again, we'll debit an expense account and credit an asset account. So this is the first time we've been introduced to the accumulated depreciation account. So with long-lived assets, what we want to do is we want to leave the asset account itself, so in this case, equipment, we want to leave it at the cost. This aids us if we ever have to sell the asset before its useful life, before it's fully depreciated. So instead, what we do is we create a special account that's linked to the asset account, called its accumulated depreciation account. And it's just an account for tracking the amount of depreciation. This accumulated depreciation is a special type of account called a contra account. And so this is a contra asset. Contra accounts are accounts that are linked. They're linked to a specific account, in this case, equipment, and they have a normal balance that is on the opposite side of what a regular asset account would. So the normal balance for an accumulated depreciation account, a contra asset, will be a credit. That's really confusing and probably technical to the point of not necessary. Just recognize that even on our balance sheet, we will see these accumulated depreciation accounts, and they will be offsetting the cost of the asset less any accumulated depreciation. You'll see an example here in a minute.
Brother Fox, sorry.
Yes.
Is there a specific formula to take out depreciation? I know
Yeah.
you mentioned something right now, but I couldn't write it down.
No, that's okay. So for right now, we're just going to use something called straight line depreciation. Okay. So to calculate the straight line depreciation of an asset, we're going to take its cost minus any residual value. Some books call it salvage value. It just means any value the asset might have at the end of its useful life. Say if you're a rental car company, you might plan to sell the cars off after they go 50,000 miles, right? And so they'll still have some value. Okay, so that's called the salvage value or residual value. So cost minus salvage value divided by useful life in years or months, depending on what you're calculating. That's the formula. That'll be in the chapter 2 in the reading for calculating straight line depreciation.
Okay.
And so
Thank
the
you.
cost of the asset minus its residual value is often called the depreciable cost, or the amount of the cost you're going to depreciate. Just so you know, in real life, we have software that does all this for us. Okay. Anyway, you're like, then why do we have to learn all this? All right. So what I wanted to show you on this slide is on the balance sheet, these depreciable assets will be listed like this, where it has the name of the asset and the cost of it. And then it will say less accumulated depreciation. And it will give you this value, which is the cost minus depreciation. We call this value the book value of the asset, or what it's worth on our books. Okay. Okay. Part 2, unearned revenues. Again, I try to keep this part short usually, but this chapter and the last chapter just have a ton of information. Maybe you hadn't noticed. You were like, this is easy, pile it on. That's probably not what you're thinking, but so this is unearned revenues. Again, this is where we receive cash before we actually earn the revenue. Okay. So this usually happens, if you think about it, this is the opposite side of the deferred expense we were just looking at. In other words, if as a business now, somebody else is paying me in advance, I'm recording that as an unearned revenue. Okay. Again, the example of my storage business, people pay me for a whole year. I can't just record that as like revenue. I haven't earned it yet. So instead I record it as a liability called unearned revenue. It's most often happens with rent, subscription-based items, and any other type of business that involves customer deposits, where the customer is paying for things in advance, okay, before they've actually used it. So here's, hold on. All right. So here's an example. The Sierra Corporation receives $1,200 on October 12th from R. Knox for guide services for multi-day trips, expected to be completed by December 31st. Unearned service revenue shows a balance of $1,200 in October on the October 31st trial balance. From an evaluation of the services Sierra has performed during October, the company determines that it has earned $400 during October. So always on these, the entry is going to look the same way, okay? The adjusting entry is going to have us debiting the unearned service revenue account. And even though it says revenue in its name, remember unearned revenue is our liability account. So we're debiting the liability unearned revenue, and then we'll be crediting the service revenue account. So what we're really doing, if you think about it, is we're reducing or lowering the liability and then recording it as a revenue. So again, when someone pays us in advance, the initial transaction would be something like debiting cash and crediting unearned revenue. And then as we earn the revenue, each month what we have to do is look and say, how much of that have we earned this month? At the end of the month, we do an adjusting entry to debit the unearned revenue account and credit the service revenue account. Okay, so now the adjustments for accruals. So for accrued revenues, remember, these are when we record the revenue before we receive the cash. So this is where we earn the money, but then we're going to bill the customer and they're going to pay us later. This says it often occurs with rent. Most places want you to prepay rent. Services performed is the most common way you'll see this happen in business, where it's pretty normal for me to go, if I have a lawn service, to go out and mow somebody's lawn and then, give them a bill and say they have 30 days to pay me or something. That's really normal in business. It's also very normal in wholesaling. Like if I have a store and I'm buying supplies or inventory from someone else, they'll ship the supplies to me with a bill saying, you have 10 days or 15 days to pay. So this is just where, as a business, I've earned the revenue, but I'm not going to receive the cash until later. So the revenue is recorded before the cash. And so the adjusting entry is always going to look like this. We're going to debit an asset account, almost always the accounts receivable asset account, okay, and credit the revenue account. So in this case, Sierra Corporation performs guide services for $200 that have not been billed to the client. So at the end of the month, we bill the client, record the account receivable, they owe us that, and then record the revenue. We've earned it already, okay? So we spent a lot more time on the deferred expense because it's the most abstract one. These ones are a little more like, but they can still be confusing. So don't feel bad if you're still trying to get your brain around it. And finally, accrued expenses. This is where the expense is incurred but not yet paid. So here, this most often happens with things like utilities. I use electricity all month. So I've incurred the expense by using that electricity, but I'm not going to pay it till I get my electric bill. Or salaries, like I mentioned before, my employees are working, so I'm incurring the expense, but I'm not going to pay them until payday. It happens with taxes, both sales tax, as I collect sales tax, then that expense is incurred, and then I have to pay it back out, and other things like that. So the adjusting entry will always be a debit to the expense and then a credit to the payable. Okay, so here's our example. Sierra Corporation signs a 3-month note payable in the amount of $5,000. The note requires Sierra to pay interest at an annual rate of 12%. So if I need to figure out how much interest I owe on something, here's another little formula you'll need. I take the principal, meaning the amount that I owe, times the interest rate, times time, and time is always going to be expressed in fractions of a year. The reason for this is because this interest rate is always an annualized rate, meaning that's the amount of interest for 1 year. So here they're just doing 1 month. So 1 month as a fraction of a year is 1/12. Okay. So principal times rate times time gives us the amount of interest. So then I record the adjusting entry at the end of the month to show that I've incurred an interest expense of $50 by having borrowed the money for that month, but I'm not actually going to pay it until, I don't know when I guess I'm going to pay it at the end of the 3-month note payable. So the hardest thing about this chapter is we have these 4 things going on: deferred expenses, deferred revenues, accrued expenses, accrued revenues, and you've got to figure out which one's happening, right? Then you can apply the rules. Yeah, I saw a question. Sorry.
You're fine. This is the interpreter for FIOT. So yes, I have a quick question for you. So I was thinking, I remember a while back, we talked about the paying rent for like a house, and you do a deposit of like $1,000 deposit, for example, and then you pay your rent. Let's say it's $1,000 a month as well, and then at the end, that original $1,000 that comes back to me. What is that called? Like when my lease expires and they give me that money back.
Right. So if I were the landlord, I would be recording that deposit as a liability. I would probably just call it, tenant deposits. And so when I received that money, I would debit my cash account. So my cash would go up by $1,000, and I would credit a liability account, probably called tenant deposits or something like that. Then I would, collect the rent. And then at the end, if you left the house a mess or if you damaged something, I would use that $1,000 to pay off any damage and then have to return the rest of that money back to you. And at that time, I would debit the deposit account and credit my cash.
Okay, that makes sense.
Okay.
So that would still be a liability. That's what you said, right?
Yes. Okay. Yeah, that's the thing with deposits is you owe them back to the person, right? And so it's a liability. Okay, another example: accrued salaries. Sierra Corporation last paid salaries on October 26th. The next payment of salaries will not occur until November 9th. The employees receive a total of $2,000 for a 5-day work week, or $400 a day. So we're left at the end of the month, we have to do this adjustment to show how much of our salaries, how much salary expense we've incurred since the last payday. Because on the last payday, we would have gone ahead and already recorded the expense for that payday. Okay. So if we paid people on the 26th, then and they worked just weekdays, then we know that we have 3 days worth that we have to adjust for at the end of the month to show that we have incurred the expense, but we're not actually going to pay it until the 9th. So again, that's important because our income statement needs to show all of the salary and wage expense or that we've incurred during that month. Okay, it has to show our revenues and expenses. So what we do is we just take the number of days, number of work days since the last payday, multiply that by the daily rate, which in this case was $400 a day. So it's going to be a $1,200 adjustment. Salary and wage expense on the debit side, and then salaries and wages payable, which is a liability on the credit side. Then on the 9th, when we go ahead and make our regular payment, we'll pay out this money plus the money the customer or the employees had earned from the 1st of the month until the 9th, and we'll get rid of this payable account at that point. All right, so this is important. This is like take a picture of it with your phone, sort of important. You don't have to, but this is just a summary of the 4 types. So prepaid expenses, unearned revenues, and accrued expenses. The accounts before adjustment, this would come in handy on 3-4, I think it is. And then what the adjusting entry will be. Okay, so with a prepaid expense, for example, before we make the adjustment, our asset prepaid expense is going to be too high and our expense is going to be too low. So we correct that by debiting the expense or increasing the expense and crediting the asset, decreasing the asset. Okay. Don't get too hung up on this whole understated, overstated language. It's confusing. Like, try to understand it, but don't get too hung up on it. Okay. All when we say something is overstated, it means that the value of the account that's on our books is higher than what it should be when it's overstated. And so the reason that for our prepaid expense that our asset would be overstated is because we've now used up some of that asset, but before the adjustment, we haven't recorded that we've used it up. So our asset's showing higher than it should be, or it's overstated. So our adjustment, crediting the asset, lowers the asset and brings it in line with what it should be. Okay. Our expenses are understated. They're lower than what they should be because before we make the adjustment, we have incurred the expense, but we have not yet recorded it. So the adjusting entry will debit or increase the expense to bring it in line with what it should be. So that's the idea behind this. As I said, don't let it just, I would use this as kind of a cheat sheet as you do the homework until your brain starts to be like, oh, okay, this is what this means. Because it's not normal for people's brain to just latch onto it and completely understand it. If you're doing that, then you're smarter than me. It took me a little while to figure that out. All right. So we already learned about trial balances in the last chapter. So after we make all the adjusting entries, then what we do is we create an adjusted trial balance, which is just a trial balance that has the new values of each account after the adjustments. That's all. Okay. So sometimes I think people like in their brain are thinking this is way harder than what it is. We had a trial balance, we made adjustments. Those adjustments changed the balance of some of the accounts. So the trial balance with all the new balances after adjustments is the adjusted trial balance. That's all. Still has to balance. Don't get tricked. All right, closing entries, because all the rest of this wasn't enough. So with closing entries, what we have to do is we have to bring the balance of our nominal or temporary accounts to zero at the end of the month. And so if you think about it, all of the accounts on a balance sheet, so asset accounts, liability accounts, and stockholder equity accounts, those accounts always have some balance to them. Okay. So we call those permanent accounts, meaning they always are going to have some balance in them. But the accounts on the income statement, those accounts have to be returned back to zero at the beginning of each new month, because that's what so the revenues and the expenses, because what we do on an income statement is we track the amount of revenue and expenses we make over a period of time. And when we get to a new month, we want to start back at zero. So we got to have a process of taking the balances of these temporary accounts, revenue accounts, expense accounts, and dividend accounts, and zeroing them out, so to speak. And then we can't just zero them out. We have to take the value of those accounts and push them over to a permanent account. And so that permanent account is going to be retained earnings. So the process of closing is just the process of taking our revenue accounts, our expense accounts, and our dividends and transferring their values all over to the permanent account of retained earnings, so that the revenue accounts, expense accounts, and dividend accounts will have a zero balance to begin a new accounting period. Okay. So here's what it looks like. Our revenue account will have a credit balance because revenue accounts always have credit balances. That's the normal balance. So to close out our revenue account, what we will do is debit that account, whatever its balance is. So our revenue account had a balance of 10,600. So to close it, we debited the account 10,600, which makes its new balance zero. And then we credited this special closing account called income summary. We only use it during this closing process. Then to close our expense accounts, they will all have debit balances. That's the normal balance for an expense account. So to close them out, we will credit those accounts an amount equal to their balance, which will take their balance all down to zero, and we'll debit the income summary account. So the income summary account will now have a credit of 10,600 and a debit of 7,740, which means if we find the balance of it, that means it'll have a credit balance of $2,860 in that income summary account. So because it's a special account we only use for closing, we now need to close it out to retained earnings. Okay, so to close the income summary account, if it has a credit balance of 2,860, we debit that account 2,860 to take its balance to zero, and then we credit retained earnings that same amount. So this process, if you think about it, summarizing the revenue and the expenses finds us a balance that's equal to our net income, revenue minus expenses. And then we close that net income to retained earnings. Because if you remember the statement of retained earnings back in the first chapter, it was our net income minus any dividends, and then that all goes into retained earnings. So this represents our net income being posted to the retained earnings account. So after we've done this, our revenue account's back to zero, ready to start a new month. Our expense accounts are all back to zero, ready to start a new month. And the net income, the difference between the revenue and the expenses, has been posted to retained earnings. Finally, we have the dividends account. Remember, dividends is the monies from the net income that we pay out to the owners. And so dividends has a normal balance on the debit side. So to close it out, we'll credit that account to bring it down to zero. And we'll debit retained earnings, which again, that reduces retained earnings. So you can see here our net income increased our retained earnings and our dividends reduced our retained earnings. So that's the closing process. It's one of those things that seems complicated, and after you do it a few times, to me, it flows pretty nicely and it starts to make sense. All you have to know is what you're trying to do, which is get revenues to zero, get expenses to zero, get dividends to zero, and all of those are going to impact the retained earnings. So there's my full presentation. I apologize, that was long. Probably the part of you that's sitting on a seat is a little tired of sitting on a seat at this point. I mean, I have about a 25-minute limit before the pain in my rear end starts affecting my brain. How about that? I don't like to sit that long. Okay, questions about these things or about specific homework assignment questions or anything like that? That must mean I'm incredibly good at explaining things and humble too.
I do have a question for you.
Okay.
Actually, if you don't mind, if we could meet one-on-one after this just for a second once everyone leaves.
That's fine. Unless it's a question that would help everybody. But okay, so any other questions? Okay, then we can close out this meeting and thanks for coming. I hope it was valuable to you. You know, like you could watch the recording afterward, but I don't think it's the same for some reason. I don't know why. You know, that's why we do these, I guess. All right. I think anybody willing to offer a prayer for us?
I will.
Okay, terrific.
Our Heavenly Father, thank you so much for this beautiful day. Thank you for allowing us to be involved in this accounting lecture. Thank you for Brother Mike and his guidance in this and taking care to help us understand these complex things. Father God, we thank you for giving your spirit to him to allow him to increase our knowledge. God, we also thank you for the interpreter that joined us, and we just thank you for all of these things in Jesus' name. Amen.
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 All right, thanks everybody. Have a great night.
Thank you, Brother Fox.
Thank you.
Thank you.
Thank you, Brother Fox.